Today on Your Money, Your Wealth, Joe and Big Al are all about investing strategies and retirement preparedness. They'll take a look at a strategy a listener has set up for his parents and run the numbers on their variable annuity. They'll kick the tires on an early retirement plan for a couple in their 40s, and they'll discuss portfolio allocations of large, medium, and small equity funds. Plus, the fellows will make some suggestions you might not expect to hear on YMYW. Investing books and target date funds, are you kidding me? And because no YMYW is complete without at least a little Roth talk, they'll also touch on how Roth contributions might affect financial aid for education. I'm producer Andy Last, and here are the hosts of Your Money, Your Wealth, Joe Anderson, CFP, and Big Al Clopine, CPA.
So we got Joe writes in from Philly, and then Joe actually writes a novel.
Wow, this goes on pages, at least the second page.
Yeah, we got a few.
Yeah.
This is called Taking Advantage.
Yeah, it's getting your financial plan for free on the radio.
That's fine, Joe. That's what we're here for, brother. He goes, hey, Andy. Spelled right?
Yes, it is.
Big Al and Joe.
A-N-D-I.
This is Joe from Philly. Look at Andy get front billing. What's that all about?
Well, she's the best.
I'm 31 years old,
thanks.
however. My question are in regards to my parents, who are terrible with money. Before I became knowledgeable in regards to investment strategies, etc., they were with an FA who put them in terribly high expense ratio mutual funds, had no dividend reinvestment, no Roth accounts, and lastly, a variable annuity really, really bad. I tossed the FA a cup. Oh, you tossed him.
You toss him.
Tossed him.
Yeah, that'd be fun to
Joe
watch.
from Philly, he's like, you know what? I'm tossing your ass out.
Forget this.
You're tossed.
I would have loved to have seen that.
I tossed the FA a couple of years ago, and I've completely overhauled their accounts to meet what I feel is a good investment portfolio consistent of low-cost mutual funds, and will continue to convert to Roth IRA funds to the top of the 12% tax bracket every year. All right, so here's mom and dad's stuff. $600,000 in an IRA, for another $200,000 in a traditional IRA, so $800,000 in IRAs, $50,000 in a Roth IRA, $30,000 in a brokerage account, $50,000 in cash. Got an annuity, $200,000. Total liquid assets is 1.1. Social Security will be taking a full retirement age. They are both 57 and a half years and will retire at 58. Well, good for them. Look at Joe from Philly tossing that FA out and getting mom and dad to retire early.
Getting them on track.
Dad plans on keeping a part-time job, $12,000 a year, as he enjoys working at a golf course and gets free golf.
Ooh, that sounds like you.
Wow. Joe, you're getting a free financial plan. I'm going to Philly playing golf with Dad. Here's a summary of the info. I hope you guys hate it when you don't. I know you guys hate it when you don't have all the info. So hopefully I gave you enough. Yeah, I think you went overboard.
Page and a half, yeah.
Okay, they ran in Florida, married finally jointly, with that will have health insurance covered by employer, $75 a month premium until Medicare. Annual income needed in retirement is $50,000 per year. Social Security taken at $67,000, $2,000, $1,000 mile drying, 50% spousal benefit. Okay, so the goal is $50,000 in retirement. Dad's going to work part-time. He got 12. So they need $38,000.
Yeah, they got 1.1 million.
They got 1.1 million, so 3.8% burn rate.
And that's before Social Security.
Before Social Security.
So that's looking pretty good.
Okay. My last venture is to figure out this annuity and what's the best move. I tried reading the 121-page prospectus, Googling stuff, and looking at the account investments, and I'm still lost. Here's the annuity information. We got a Prudential Premier Retirement B Series, purchased 8 years ago for $120,000. Surrender value of $210,000, death benefit $210,000, lifetime income basis of $220,000, steps up $67,000, and guaranteed growth rate of 5%, guaranteed lifetime income of $8,000 per year. Annualization date 2057. WTF? Why is this so late? It's like, man, what the? They haven't withdrawn anything yet. It looks like they are getting $500 withdrawn every 3 months as a miscellaneous fee with some other BS.
Which is some BS.
It is BS. Totally agree with you, Andy. Having a hard time figuring this all out, but overall this annuity seems bad, real bad. So my questions are, number one, if they take the surrender value now, will they have a 10% penalty since they are under 59.5, correct? That is true. So if they took the money out of the variable annuity, it depends though. Joe, one key thing you're missing here.
Yes.
Is it non-qualified or qualified?
That is the key question. In other words, is it in a retirement account or not? So if it's not in a retirement account, yes, they'll pay taxes on the gain plus penalty.
If it's in a retirement account, you could easily get out of the annuity and put it into your low-cost mutual fund portfolio.
Yeah, they'll still have surrender charges, but there's no tax and penalty.
Well, it says surrender value 210,000, lifetime income is 224. So
it's pretty close. Maybe, yeah.
I don't know if they'll have.
Maybe not.
But the lifetime income is something different, and I can explain that.
Okay.
Do you think they should stay in the annuity or surrender it and put the money into a brokerage account to invest in bonds, then draw down during retirement? All right, so this helps. If it's a brokerage account, maybe it is non-qualified. Do I want to surrender that thing and put it into a brokerage account into straight bonds to draw down?
Yeah, that makes it sound like it's a brokerage, non-retirement.
Right, non-qualified annuity. No, I don't like that idea. I don't mind surrendering it, but you got to be. You just don't want to put it all in bonds, right? You want to do maybe the opposite here. Number 3, do you pick the date when you start withdrawing in the annuity after 59.5 and start getting the $8,000 or whatever it grows to? I read that damn prospectus and I'm now more confused. Thanks for your help, and I love the podcast. I listen to you guys every day as I go to work for the man so I can retire ASAP. All right, Joe. Okay, so let me help him out. So mom and dad bought an annuity. So there is a guaranteed growth rate, and that guaranteed growth rate is not on the principal. It's based on the lifetime income. So it's a guaranteed income benefit rider that they have on this annuity product. So they put in a couple $100,000 or $120,000 8 years ago. So let me just make sure my math is tight. 120,000, 8 years. 5I, future value there. Okay. So we got death benefit of $210,000. Lifetime income is $224,000. And so the guaranteed growth rate, 224,000, 5 there is 11. Okay. This $8,000 a year doesn't make any sense to me because their lifetime benefit is $224,000. If I look at 8,000 into 224, right? That's 3.5% guaranteed. That's not great. That's awful. Usually you see a 5% guaranteed on that income because they'll give them a roll-up. And then they'll say, you'll get a guarantee of X throughout.
Yeah, and that's based upon a factor. And yeah, that's right. I've usually seen with you that 5%.
Yeah. So if I'm looking at 120,000, so they start taking income, and I'm not sure when the income turns on here, but let's just say it's 65, steps up at 67. So it's going to take 15 years with that $8,000 guarantee for them to make a dime on this product.
To get their money back.
To get their money back.
And that's one of the problems. You think you got this great rate of return, and you're basically just getting your money back in 15 years.
Right. So they're giving you $8,000. They're giving your folks $8,000 a year. But they already put in $120,000.
They're giving them back their own money.
They're giving them back their own money over a 15-year time period, and they're taking that, the money, and they're investing it to try to get a lot higher rate of return. That's why insurance companies are very profitable. So if you look at it that way, it's just that you have to figure out what the internal rate of return is on the overall product, not these BS returns that they're kind of saying that they're giving you, because you truly don't get the 5% because that's a roll-up, I'm guessing. So do you get out of it? I would. I would imagine the fees on this thing is probably 4% with all the bells and whistles on this thing, or maybe 3.5%. So if I go at $220,000 as the cash surrender value, let's say your fees are 3.5%, they're paying $7,000, $7,700 a year for the product to get an $8,000 a year guarantee.
Right.
So the fees they're paying are going to pay their income.
Right.
Joe, is this all making sense? Is this helping you find your way? I would do this. I would go to Vanguard, open up a very low-cost variable annuity, do a 1035 exchange, or 1035 exchange from this product into a very low-cost, no fee, no gimmick variable annuity until they turn 59 and a half. And then you could potentially get out. But they're going to have a $200,000 tax gain here because they put $120,000 in. The cash surrender value is $210,000. So they got, $100,000 of gain here.
Right.
All of that is going to be taxed at ordinary income rates. So if you want to keep it in the annuity and slowly bleed out that gain, you could do it that way.
Keep them in lower brackets. Maybe sort of focus on that for the income for the first several years.
Right.
That could be a way.
Because if you blow out of this thing, they're going to get hammered in tax.
Yeah, for sure. Tax plus penalty right now.
Yeah. So, they would lose half of this thing. They would just get their basis back.
Right.
And the insurance company would say, hey, thank you very much. We really appreciate doing business with you.
Free money for 8 years.
Yeah, right. So I don't think they need the guaranteed income because they're spending $50,000 a year. Joe Sr. is working at the old country club, making a few bucks, playing free golf, right? Having a couple of pops on the 19th hole. He needs, some walking around money. He could delay his Social Security to probably age 70 because the distribution rate on the total assets that they have is 3.5%. So you start bleeding 3.5% out until age 70 versus 67, or I don't care, take it at 67. And then all of a sudden your distribution rate is going to be probably 1.5.
Very low.
It's very low because they're right. Their Social Security and will cover a lot of their living expenses.
So the whole plan looks fine financially. It's just a matter of making it better. And yeah, this annuity doesn't sound like a great long-term product for them, for sure.
Well, I guess what's the rationale? It's not an investment, first of all. It's not an investment. It's an insurance product. And so if they want to transfer risk to get a guaranteed income, then keep the product, right? But just know that you're not going to get returns like an investment. Just like with any insurance. It's insurance. It's income. So people look at this. It gets sold as an investment, but it's not an investment at all. If you're looking to say, hey, you know what? I want a guarantee of $8,000 a year for the rest of my life, then keep the product. But your internal rate of return on that product is going to be significantly lower than you could probably do outside of the product, but then you're subject to risk. There is no guarantee. So then you're taking on stock market risk, interest rate risk, inflation, all sorts of different risks if you get outside of the product. So there's trade-offs. So those are the decisions, Joe, that I would make. I wouldn't worry. It's like what's done is done. If you go, Mom and Dad, this is going to give you a guaranteed $8,000 a year, and there you go. It's not going to be adjusted for inflation. It's probably going to give you a rate of return over your lifetime, depending on how long they live. Maybe your mom and dad live into 125, and this could be an awesome product. So if it's sold in as an investment, it's dog, you know what. But if they bought it to say, I want a certain guaranteed income, then it is what it is.
It's longevity insurance. You can look at it that way.
You got it. So, all right. Well, Joe, hopefully that helps. Keep working for the man. And maybe you should be a financial advisor.
Yeah.
CFP.
And he could toss out the ones he didn't like.
Yeah, you could just be the top.
Kind of clean up our industry.
Yeah, exactly.
Learn even more about variable annuities by checking out the free resources in the podcast show notes at yourmoneyyourwealth.com. Click the link in the description of today's episode in your podcast app to learn what variable annuities are and to find out some truths about them from one of Pure Financial's affable senior financial planners, Matt Balderston, CFP. While you're there, you can also download our retirement readiness guide for free to learn tips to make sure you're on track for retirement or early retirement, as the case may be with our next question. And if you have money questions, click Ask Joe and Al on air in the podcast show notes and send those questions in as a voice message or an email.
Karen from Florida, she writes in. Hello, Joe, Al, and Andy. Love your podcast and have learned so much from all of you. Thank you. My husband and I live in Florida and planning to retire in 3 to 5 years. He is 40 years old and works for the fire department. I'm 42 years old and a registered nurse. So you're going to retire at 45. It's a hell of a...
That's a great thing.
It's a hell of a...
Right.
We are happily child-free.
Yeah, go Karen.
Oh, all right. I believe we are on track to retire, but I want to make sure I'm not missing some key elements that can derail our plans. Current expenses, $60,000 a year. And plan to maintain this level of spending in retirement, maybe even less, since we plan to spend months in other countries where the cost of living is lower. Currently, we have a net worth of $1.1 million. $300,000 in a 403B, maxing that out. 457, 150 grand there, maxing that out. 2 Roth IRAs, $200,000. And then 2 brokerage accounts, $144,000, contributing $54,000 combined. 1 brokerage account specifically for the purpose of a home in the future, $240,000, no contributions. Okay. So they got 3 total brokerage accounts? 2 brokerage accounts, $144,000.
Yeah.
One joint brokerage account specifically to purchase the home.
So we can't really count that in the net worth because.
So they each have one and then they have one together.
Because they need it for a home.
Got it. Cash, $100,000. Husband also has a pension of approximately $17,000 a year to start at 62. Reduced amount since he'll retire early. And we should also qualify for Social Security, but it will just be icing on the cake. For the first 15 years of retirement, we plan to use the bucket method in our withdrawal strategy. Oh, the bucket method.
I wonder who that came
I
from.
don't know. Cash, $10,000 a year. Brokerage, $30,000 a year. 457B, $24,000 a year. 403B to Roth conversion, $48,000 a year. I believe this strategy will keep us in the 12% tax bracket. Okay, 30, 40, 50, 60, 40. Yes, you are right.
64.
We'll definitely keep you in the 12% tax bracket.
Well, plus the Roth conversion, we got to add that in. So call it 110 approximately minus standard deduction.
Yeah,
it's close.
At retirement, we plan to be more conservative in our investments, maybe 60-40 stocks to bond split. What am I missing? Thanks so much. Okay, let's kind of look at this here.
Well, if we sort of summarize this, so they've got 1.1 million, but they want to earmark about 240 for a house. So really, and I'll just round it to their benefit, they got 900,000 to work with, and they're trying to produce 60,000 of income per year, right?
Let me just, I'm doing the math again here. 200, and then we got 150. That's 821. 100,000 cash. I got 921 plus the 240, right? 1.1.
Yeah. So I think you got 900 to work with, and you're trying to produce 60 grand, right? So that's a distribution rate of over 6%.
At 45.
At 45, and probably, I don't know whether, Karen, you've considered health insurance, which is at least a minimum $1,000 a month for each of you. So that's another 12 grand right there. So I think this is pretty tight.
$900,000. Let's say that's what their working capital is to create income. At 45, I would use a 3% distribution rate.
I would too.
So that would be $27,000 of income that you would be able to generate.
So not 60.
Right. So if you want $60,000 of income, 0.03 divided is $2 million. So if you can make the $1.1 million into $2 million in the next 3 to 5 years,
right.
Well, then you got something. Because let's see, $1.1 million is the present value. They're saving $54,000 into the brokerage account, plus they're maxing out the 403B and 457. So they're saving roughly $100,000 a year. Probably. Let's call it 90,000.
Yeah, saving a lot.
Right? 50 plus 40 is 90 plus.
Well, 20. Yeah, call it 20 and 20 on 401ks.
Right,
Yeah. Okay.
All right. So 90,000.
But I would start with 900, not 1.1.
No, that's what I did.
Okay.
Yeah.
Okay.
Yeah. 5 years. Say you get 7% because you're all in stocks. Future value of that is $2 million.
Okay.
So if you could save $100,000 a year for the next 5 years and get 7% on your money, that would equate to about $2 million. And then you take 3% onto that, and that could probably get you close to your income.
Now, so that's right. So a couple more things besides health insurance. If you're going and living in other countries, are you giving up your home here? Because otherwise, basically, you've got double expenses where you're staying plus your vacant home here. unless you're renting it out or something like that.
Mm-hmm.
So just be aware of that. I think what we normally see more often than not is when people do something like this, they end up spending more than they're currently spending because they're kind of on vacation, if you will, right? They're wanting to go out and do things. So just be careful of that. Think carefully about what you really do want to spend.
Yeah, and then Karen, also, if you're retiring at 45 years old, your Social Security benefit's going to be pretty low, just because
it's the highest 30 years, and you have lots of years where you're not working.
Right. So yeah, it could be icing on the cake. But as a firefighter, here in
there might be
Southern California, the firefighters get a fairly significant pension.
They do, and that's not listed here.
But they said husband will have a pension of $17,000 a year starting at 62.
Oh, 62, yeah. Okay.
That's not a ton.
Maybe he hasn't done that for a long time.
But I mean, that's why I was thinking early retirement as a firefighter. We see firefighters retire early all the time.
Yeah, and they end up making 70% of their income.
Yeah, or 90.
Yeah, sometimes.
So if you're a chief, it's 120% of your income.
See some big numbers on that.
Okay.
Yeah. So, I mean, Karen, I like your thinking. I just think just be careful on the numbers because you don't have enough capital right now to do this. But if you save and earn a certain rate of return, you probably would. But I'm a little concerned you might be spending more than you think. Plus, in 5 years, there's inflation, so 60 is going to be more than 60. So just a couple things like that to think about. Now, sometimes when people really want to do this, and I'm not telling you not to do it, I'm all for it. But one of you or both of you might need to have some kind of part-time income just to plug the gap. So just be aware of that.
Right. I mean, think of it like this: is that if you want to. If you're 45 years old, right?
Can you relate?
I can relate, right? I want to retire too, Karen. I want to travel with you. All right. I'm single, no kids, right? I'm part of, it's a trio.
Yeah.
Right?
Yeah.
Karen, myself, and the firefighter.
Yeah. There you go.
We're about the same age. And,
right.
No kids. You're married. That's fine. I'll third wheel it.
Well, we have to find out where they want to travel because you don't like traveling. That's the problem.
So we'll have to figure that out.
Yeah.
Then we'll throw in my few bucks and we'll call it good.
Maybe that's the way to go.
Maybe. But for being in 42 years old and having 1.1 million it's incredible. It's phenomenal.
Yeah.
It's saving $100,000 a year. Congrats. But I know the feeling of, all right, well, here, I got $1 million.
So I'm good. Yeah. Because that kind of was everyone's goal for a long time.
Right. So $1 million is still a ton of money, but when you equate it into income at 40, it's not as much as you might think.
So here's how we kind of think about that. If you're 65 and you got $1 million, you can probably use a 4% distribution rate. So that's 40,000 of income. At 45, since the dollars have to last so much longer, we might want you to do a lower percentage. That's why we said 3%.
But also, they got at least 40-year life expectancy.
Sure.
That's given today's technology in regards to healthcare. If we were Rick Edelman, we would
live to 120.
You were going to live to 200.
He would say 200. You can't retire till you're 75.
Yeah, and you're going to have 17 careers.
He does say that.
You're going to go back to school 14 times.
Right.
I love Rick Edelman. Just FYI.
I do too. I know him by first name.
Ooh, wow. Look at you, Al. You're celebrity status.
Name dropping.
Can I help you pick that up? Oh, God. All right. Thanks, Karen. Good luck. We got another question. Clint writes in. Hi, Andy, Big Al, and Joe. My wife had a no-cost $10,000 account with Motif, which was a trading fund that dealt with sustainable energy in eco-friendly companies. They sold, right? Yeah, Motif was sold to or bought to Folio, who is now managing the account at a rate of $220 a month. My wife is uncomfortable with trading and paying a monthly fee. She is now asking me for advice. This is where YMYW comes in. Can you direct me to a path of happiness where I can appear to be a hero of advice? Are there other zero-cost investment strategies that can safely manage a $10,000 investment? It's not play or retirement money. She would also like to make more than a CD or savings account. Would a money market account be something to look into? Thanks, Clint. Okay. All right. Well, first of all, there was a fee. She just didn't know what she was paying within
Motif.
Mm-hmm. And it was pretty small. But now they're charging $20 a month on $10,000. It's a couple $100 on 10 grand. I can see, hey,
yeah,
you know what? It's kind of egregious.
Almost 2.5%.
So plus, if they kept the actual chassis of the investment in place, you know, there's
you're paying for nothing, right?
Yeah.
Unless you're going to be trading,
right? You could do a couple of things, Clint. Maybe. Well, Charles Schwab has 0 transaction fees on some target date funds or things like that.
Yeah.
If she wants a trading account, there's Robinhood. They're in the news quite a bit.
They are
lately.
They've got some technical issues, right?
Well, yeah, because it's a ton of hot money. I mean, right? You gotta. I mean, it's the millennials.
Right.
You got some. The average balance of a Robinhood account is $2,000.
Couple grand. Okay.
And they got like 6 million people on there.
Right. Sure.
And then so we're getting questions from clients of saying, you know, people are gambling, and how's this going to affect my overall account? And it's like, okay, well, first of all, you know, BlackRock is not gambling.
Yeah.
They're individuals that are gambling with their overall investment accounts.
Right.
You know, day trading's back.
Yeah.
You got Dave Portnoy out there from Barstool Sports making it fun because there's no sports on.
Yeah. So you might as well do day trading.
Yeah, day trading.
It's like horse racing.
Gamble.
Right.
Right. So, I mean, there's a ton of press on that stuff.
Right.
And a lot of the investors on Robinhood were putting money into the overall accounts during the pandemic and still doing so. They're loving to see the market just crumble. They're like, oh, great buying opportunity.
Right.
So, and then some of them are losing their shirts, and so on and so forth. So you could go into Robinhood. It's free. There's free trading there.
Okay.
But I'm not sure if Clint's asking us that she just wants a set it and forget it type of investment strategy just to avoid the $20 a month fee.
Yeah, that could be. And it needs to be, sounds like it needs to be relatively safe.
Yeah. But if she had a sustainable energy fund.
Right. It's a little mixed up. Well, so one thing, she would like to make more than a CD or savings account. Would a money market account be something to look at? The answer to that is no. Money market accounts paid almost nothing.
Well, yeah, but it's almost the same as a CD or a savings account.
Well, yeah, but a CD generally pays more. Money. The banks that I've been to, including my credit union, the money market pays like a checking account, almost nothing. I mean, maybe 0.01%. You know, 1/100%.
It seems like you're pretty upset about that.
Yeah, Steve. So
it's not paid me anything.
So then I opened up a CD. You know what I got on that?
What?
1.
There you go.
I got a full percent.
You got a point.
But anyway, so you know, as far as what to invest in, it depends upon what the money's for. If you're going to need the money in the next 3 years, then CD, money market savings is probably your way to go because you never know what the market's going to do in the short term.
Are there other zero cost investment strategies that can safely manage $10,000? Okay, well, he's asking for a strategy. You could go into like a Vanguard, you know, target date fund that's a strategy that has stocks and bonds that is somewhat conservative depending on what year that, you know, you want to pick. You could pick that retiring in 2020, so it's going to be mostly bonds. It's fairly inexpensive, you know.
What's the name of that book, the best investment book you'll ever read? I forget the author, that attorney.
Dan Solon?
Yeah. That's a book he could read, right?
He's not asking for a book.
But that'll give him,
we're the ones that read the books.
I know, but I'm going to give him the strategies. Go get that book and read it. It's not that long.
True.
Or you could listen to Joe talk for the next 4 minutes.
He's like, oh, that sucks. I was a fan, not anymore. Sorry, buddy. Wish that out. I hopefully that out. But there's Schwab that had zero trade, zero ETF, you know, very low cost. Fidelity, Vanguard, they all have strategies that are very low cost.
But I'll go back to that book. What's it called? The best investment book you'll ever read. I think that's what it's called.
Yes.
Anyway, so, and you can just skip to the chapter on whatever.
Building a portfolio.
Yeah, right. And he goes over how much to put in, like you pick 3 or 4 different funds and you're done.
Okay.
That's a strategy.
Yeah. I mean, it's total U.S. stock market, total international market.
Yeah,
small.
that's right. Total bond market. It's actually those 3.
Yep. And then it's just a variation of that.
Yep.
All right. Cool. Thanks. Thanks for the email, Clint.
Hey, how is your investment mix and why is it like that? Learn the ways to grow your investments in all market environments, how to avoid poor investing decisions, and how to protect yourself from risk. Download 8 timeless principles of investing for free from the podcast show notes just before the transcript of today's episode. That white paper will help you feel more confident in your portfolio, even in times like these when markets are volatile. Click the link in the description of today's episode in your podcast app to go to the show notes and download 8 timeless principles of investing and to ask Joe and Al your money questions. Speaking of investment principles, let's talk now about portfolio allocation.
We got Steven writes in from Orange County. He goes, "Hi, Joe, Big Al, and Andy. Continue to appreciate your podcast for the knowledge and humor. You guys do a really good job. I'm 9 years away from needing to access my retirement funds to live on. Other than the RMD starting in 5 years, which will be reinvested into a brokerage account, I have 2 questions. My retirement funds are presently divided between 65% equities, 35% fixed income. I'm mostly a moderate aggressive investor and was wondering what percentage of my equity position would your firm usually recommend the asset allocation be located in, between large, medium, and small funds, as well as between U.S. and foreign funds." Okay, so Steve's looking at, all right, well, what would our portfolio look like if what's the makeup of our portfolio?
Yeah, what's the split between foreign and domestic and large, medium, and small?
With a 65-35 split?
Right.
Or is he asking us what the split should be
Well,
in regards to, because that's the first decision you want to make when you're constructing the portfolio.
Yeah, we can answer. Well, let's start there, right? And I think that the way you figure out how much the split should be is based upon your own needs and goals and a required rate of return. And we always believe that it makes sense to have the most conservative portfolio possible to be able to achieve the rate of return that you need. And so maybe 65% equities is the right number, maybe not, but that's where a little financial planning comes into place. It's like, you know, how much do you want to spend in retirement? What kind of fixed income do you have? Social Security, pension? What's your shortfall that has to come from your investments? You divide that into your total investments. What rate of return is that? And then you design a portfolio to try to achieve that. And I got to say, if you're getting much more than 6 or 7%, you're kind of in the danger zone in terms of a required rate of return. So you might want to think about either cutting expenses or working part-time or something like that.
Well, you mean that if my required rate of return is 8% for me to get the distribution that I need and combat inflation?
Exactly. And plus you got to add an inflation factor, right? So if you're getting 6%, you might need to earn 8 just to be able to have enough kept in your portfolio for inflation.
So in other ways, that you don't want to take out more than roughly 3.5-4% out of the portfolio.
That's another way to say it. Yep.
So we're finding all sorts of ways to save a 4%.
But isn't that educational, right?
Okay. So I guess to kind of give you a high level, what the mix would be. Let's say if you had a 60-40 or 65-35 equity to fixed income split, we would probably have 60% of that of the equities in domestic, 40% in international, give or take. Probably it would be tilted more towards value type companies. Small companies, we would probably have a 10% exposure.
Yeah, I agree with that. I got some recent stats from Statista.com.
Okay, well.
So this is U.S., this is capitalization. In other words, the value of all the companies in the world. 54% of the value is in United States. And
the total market.
Total market capitalization.
Got it.
Yep. The second biggest country is Japan at 7.7, so it's a lot lower, and then followed by UK at 5% and China at 4%. So one way you could say is, well, maybe 55, 60% in U.S., which is what you just said, which I agree with.
I didn't even need Statista to help me with that.
I know that was off the top of your head. You just like hear it and respond like a computer.
That was good.
Anyway, here's what I have to add to that, though, and that is some people find they don't really like to invest that way because all they look at is the Dow and S&P.
Well, yeah, you got to look at the appropriate benchmark as you're investing.
But some people just don't, right? And because then we're bombarded with S&P or Dow did this today, right? So if you're investing 60% in U.S. stocks, then only 60% of your equities are going to follow U.S. So just be aware of that. Some people have troubles with that. We call that tracking error. Mm-hmm. So tracking error, you have a different rate of return than what the S&P 500, and if that's you, then do more than 60%, go 80% US or 90%.
Well, I still don't think that's the right advice.
I think, well,
just because they're not necessarily following the right benchmark. So here, let's have a really crappy portfolio so that you can better benchmark your portfolio watching CNBC.
Well, here's what I mean to say, I guess, is sometimes when people, they don't track the S&P 500, and then they get disenchanted with the whole investment thing, and then they make poor decisions.
But if it was 2000 through 2010, they'd be pleasantly surprised.
I know, right? And the truth is, if you look back, you know exactly what the percentages should be. If from 2000 to 2010, you should have been 100% in foreign. And nothing in U.S. And from 2010 to 2020, you should have been 100% in the U.S., but you never know what's going to be better.
Right. If you had a crystal ball backwards, right?
Yeah.
You could.
Yeah, that would be good.
But yeah, a globally diversified portfolio, I would recommend, 50, 60% in U.S., 40% in non-U.S., just because of the market capitalization, as Alan talked about. 40% or 45% of the market cap is not in the U.S. It's
That's
still
right.
globally. So
correct. Yeah.
You want to make sure that you get exposure there. What percentage would we have in small, medium, large? I mean, you could do it depending on how sophisticated you want to get here, Stephen. I'm not sure how much money that you have, what's in non-qualified versus qualified versus Roth, because each of those different accounts want to have different asset classes in it just because of the taxation. And what the overall demand of the portfolio is. He's 9 years away, needing access to retirement funds. So, so he's still 10 years out.
Yeah.
So you kind of want to get a glide path to slowly get more conservative.
Yeah, that's true.
So there's a bunch of different things, but high level, you can tilt the portfolio more towards small in value. You're going to have more volatility. You're going to have more risk in the equity side of the portfolio, but you'll probably get a higher expected return in the long run.
But one thing I want to say on that is, if you look at a cross section of companies out there that you can invest in, they're mostly large. I mean, the biggest market capitalization. So if you just try to pick the U.S. total stock market, for example, which Vanguard and others have funds that kind of mirror that, it's going to be mostly large because that's what there is to invest in. So when we say tilt towards value or tilt towards small, you might only have 6 or 7, 8% instead of 4%, right? It's not like we're saying do 50% in small. It's just tilt a little bit more that way. You get a higher rate of return over the long term, but what you're giving up for that is what you're receiving with that is volatility. So it's a little bit more of an uncertain ride.
Right. I mean, if you think of it like this, is that let's say you have a cherry pie, right? And then you're going to put these cherries in the pie, and then you cut a slice of the pie, and there's going to be some cherries in there.
Yeah,
right.
Hopefully.
Right. Hopefully, or you could get skunked.
Because my brother could have been there and picked out the slice before you got your piece out.
Right. But what we're doing is we're trying to jam pack each slice with, cherries, if you will. Right?
Yeah.
Because if I buy a total U.S. stock market index fund, you're going to have small, mid, and large within that fund, but it's going to be heavily weighted towards large companies just because of how they construct the overall fund.
Yeah.
You could then split up the funds and saying, I want to have a fund that's specifically looking at an asset class, such as smaller companies. So then that also is going to be heavily weighted towards the largest, smallest companies.
Right.
So then that's when you get more on the institutional side of what we do is then they package those different funds up so you can get the best slice of that particular pie.
Right. You're getting a true slice.
Yeah, then it's just how it's constructed, right?
So it's, instead of having a triple berry pie, you just pick the berry you want.
Yeah, there you go.
So it's not blueberry, boysenberry, blackberry. You can get the blueberry pie.
You got it.
Got it.
All right. So second question here from Stephen is that I plan to start doing Roth conversions for my grandchildren in the years ahead. Hold on, let me read that again. I plan to start doing Roth contributions, for my 5 grandchildren in the years ahead. My oldest, age 16, started working part-time this year. Can my son open this account for my granddaughter and I contribute the funds of $6,000 depending on her income yearly for the next few years? As well, would her having a Roth in her name be counted against her with respect to financial need when applying for college loans in several years? Thanks for the input. So he wants to start doing Roth contributions for his 5 grandchildren.
That's great.
Which is very cool. But and then I think he gets it is that Stephen's saying, all right, well, here, for me to make the contributions on the grandchildren's behalf, they need to have earned income.
Yeah, which is true.
So
agreed.
If they're starting to work part-time, then your son or you can fund those Roth IRAs, but the Roth IRAs would be in that child's name as long as they have $6,000 of earned income.
Yeah, or whatever they have. If they got $2,500 of income, you can put $2,500 into Roth, and it's just fine that you put it in. It doesn't have to be from her.
Right. It's not an account like a 401k that it has to come from the paycheck.
Right.
So will it count against loans? Yeah, I think any asset in that case, but I'm not sure how old they are, and college will be free by then, Al.
That's maybe, huh? We'll have to see, right? It's certainly, if you're looking for financial aid, if your grandchildren are looking for financial aid, any assets that they have will definitely count against them.
All right. We'll see you next week. Show's called Your Money, Your Wealth.
Check out some additional free resources on asset allocation in the podcast show notes at yourmoneyyourwealth.com. Just click the link in the description of today's episode in your podcast app to get there. And get your derails here, coming right up after these words from our sponsor. Your Money, Your Wealth is presented by Pure Financial Advisors. For a much more detailed and personalized analysis of your financial situation than you can get from listening to this podcast, click the big green button that says Get an Assessment at yourmoneyyourwealth.com or call 888-994-6257. Schedule that free financial assessment video call with a certified financial planner from Pure and find out if you're actually on track for retirement. Visit yourmoneyyourwealth.com or call 888-994-6257. That's 888-994-6257. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full and informed investment decision.
Joey Anderson here, Big Al Clopine, talking about financial matters stuff.
Wow, that was smooth.
That was a really good transition there. Oh boy. You know what I've realized? On these segments, have I been closing on time? Because I don't think I've even looked at this clock.
Yeah, you've been closing.
Yeah, you have. What do you
Been
mean?
amazing. You just have an innate
right.
sense.
I feel.
You feel it coming.
Yeah.
Because I'm staring at you. It's
Yeah.
like, come on.
How angry would that make you if all of a sudden they made college free?
Well, I would just, I wouldn't worry about it. You know me. I would go have a yoga session. I would have soul and body, and I'd let it go.
You got pretty heated that one time when we talked about your college expense.
Yeah, well, that's a long time ago, fortunately. So it's kind of faded.
It's faded.
My youngest is 27, so.
Okay, all right.
Yeah. Anyway, that's he went
Enough
to
already.
University of Colorado Boulder. It was not cheap. Which no, I don't want to bring that back, Joe.
Alrighty.
And here's what I sound like when I accidentally have a sample rate conflict.
Today on Your Money, Your Wealth, Joe and Big Al are all about investing strategies and retirement preparedness.